Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency markets this week and in the weeks ahead. Today I'm joined by our two heads of G10 FX strategy, Paul Robson, based here in London, and Brian Daingerfield in the US. Brian, I'm going to start with you because it was really Japan upper house elections that really grabbed the narrative of FX markets and actually broader markets this week. Why was the upper house election so impactful for financial markets?
Yeah, thanks very much for having me, Eimear. So the upper house election in Japan was important for markets for a number of reasons. The story in Japan in the government for the last few years has been, Prime Minister Shiba coming into power, but the LDP, the ruling coalition, having lost ground in recent elections. So last year they lost their majority in the lower house, and the upper house was up for contesting this time around. And I think the big narrative in the market was, would the LDP and their ruling coalition once again lose their majority? So that would leave the ruling LDP in an unusual situation of being the largest party and the party of the prime minister, but also without majority governments in either the lower or upper house. And so that's exactly what happened. The LDP coalition lost their majority in the upper house in this election. This had a number of implications on fiscal policy and on the future of the prime minister. Now, this is another election where the ruling LDP underperformed and again lost their majority, and that's led some in Japan to question whether the Prime Minister Shiba, is likely to stay on in government. Another implication is that if you were to get a change in leadership within the LDP, whether or not that means you're going to have a change in policies. In particular, the focus for foreign exchange markets has been fiscal policy, because the LDP and the leadership of the LDP has been one of the few parties in Japan that's been pushing back on reducing consumption taxes. So consumption tax hikes is one of the big fiscal austerity measures that had been previously taken, and the LDP ruling coalition has been leaning against cutting the consumption tax to provide stimulus for the Japanese people who have been under pressure from higher prices. Most of the other opposition parties have been calling for some fiscal stimulus in the form of reduction of taxes, including the consumption tax. And so the assumption in markets was that if the LDP loses their majority, which they now have in the upper house, that one of the consequences could be that they have to move a little bit further in terms of moving towards the opposition parties who have been calling for different levels of consumption tax reductions. So that's been the big focus. I would say those have been the two pieces that have really been the most market influence, which is if the LDP were to lose their coalition, lose their majority, which they have, does that imply some limited loosening of fiscal policy, or maybe in an adverse scenario where they were to lose even more of their majority, maybe a wholesale change in their stance on consumption taxes and on fiscal policy leaning towards fiscal stimulus? And then additionally, if the scale of the loss for the leading coalition could endanger the prime minister's status as leader of the party and the prime minister. And questions have certainly swirled about whether or not he will stay in power after this coalition lost the majority. So those are the sort of factors on the ground I think have really been driving markets here.
And I guess how do those fiscal implications really play in actually to monetary policy, right? We've got BOJ next week, and obviously in turn the outlook for the Japanese yen.
Yeah, so I think in the yen, for sure, I think we've seen a little bit of a buy the rumor, sell the fact type of impact here, where the Japanese yen has shown meaningful correlation with the long end of the Japanese yield curve. And I think the concern has been that one of the big implications, of course, was fiscal stimulus, and that fiscal stimulus could come with additional borrowing. And Japanese long end yields in the Japanese yield curve have risen. They rose in anticipation of this election, and in the aftermath, albeit with some stability initially, have since resumed that increase. And the market's read-through has been that additional fiscal stimulus could lead to higher rates. And if that were to happen in a volatile way, that could lead to additional downside in the yen. And the yen had actually sold off not only against the dollar, but on crosses heading into the vote. Since the vote, as mentioned, long-term yields have continued to rise as markets price in additional fiscal stimulus, but the yen has actually recovered a bit of ground against the dollar. We've actually moved a bit lower, and it seems like maybe that correlation between longer end yields moving higher and the yen coming under downside pressure might be weakening a little bit here. And I think that does relate a little bit to the Bank of Japan, because not only do you have the potential fiscal stimulus which could be inflationary. That could be a hawkish impulse for the Bank of Japan down the line. There's also the trade deal inked between Japan and the United States that's happened since the election. So now, of course, the timing of the trade deal is quite interesting. Certainly feels possible that they needed to get the upper house election out of the way before coming to the final terms of a deal. That certainly feels possible given we had a deal clinched just a couple of days after the upper house vote. But nonetheless, this is something that, it sort of clears the deck a little bit in terms of tariff-related uncertainty for the Bank of Japan. So the big narrative for the Bank of Japan has been that as long as they're under this tariff uncertainty, it's unlikely that they'll be able to resume normalization. Now, they're going to have to figure out, where the growth outlook settles out now that we have some certainty. But with a trade deal in hand, tariff rates at 15% are higher than they were certainly in 2024 before the incoming Trump administration. And I think they're higher than I think Japan might have hoped otherwise. But in autos, where there had been subject to the 25% sectoral tariff, there's also been a reduction. And that is the largest export market from Japan to the United States. So there is some positive there. So now the Bank of Japan will be making their upcoming decisions in July next week and also beyond, with perhaps some reduced uncertainty related to tariffs, but also some potential expectations for fresh fiscal stimulus, which could bring with it higher inflation. And so that combination, I think, has allowed the market to maybe entertain the possibility that maybe Bank of Japan can consider resumption of normalization, resumption of rate hikes, maybe sooner than it otherwise would have. And so I think that's part of the reason why we've seen the yen recover a little bit here. It hasn't been a massive recovery, but we have seen a bit of a differentiation now where long-term rates in Japan have continued to move up, but the yen has been more stable and in fact a little bit stronger against the dollar. And I think that BOJ piece of the puzzle here might be part of that.
And obviously, Japan is not the only major central bank to make a decision next week. In the midst of a very busy week in the US, we also have the Fed decision. Are you expecting any major policy changes from the Fed?
So on the policy side, no. I think it's pretty clear that the Fed is going to leave the policy rate unchanged, to the detriment and chagrin of a certain individual, the President of the United States. He's certainly been advocating for the Fed to be moving more aggressively. But I think the question for markets will be, how does Powell's communication reflect the odds of a cut as soon as the next meeting in September? I don't think the Fed is in the business of ruling anything in or out. So I think if Powell is asked straight up, is the September meeting live? I think he'd have little choice but to say that it effectively could be in play. So I think that would be the important factor, is how does he discuss the conditions on the ground, and how does it relate to the September meeting? Because what the Fed has been telling us for the last couple of months is we want to wait for evidence around tariff-linked inflation that they think is going to be showing up over the summer, and that allows them to make decisions at their autumn meetings with perhaps more information in hand. So I think that goes nicely to say that they'll have a couple of more CPIs and PCE deflator prints between now and the September meeting. I don't think they want to rule anything out. It would fit nicely that if the conditions were to merit it, that they could consider moving in September. Now, the markets are already effectively on this train, and there's a couple of individuals at the Fed that we know are already advocating for a cut, not in September, but actually at the July meeting. So we expect those individuals, who happen to be the two Trump appointees at the Board of Governors, Governors Waller and Bowman, to dissent at this meeting. And I think it's going to be pretty clear that the conversation under the surface at this meeting is probably going to be pretty active. There will be some on the more dovish side who are seeing the progress on services inflation, the continued progress on shelter inflation, as a sign that the overall inflation picture has moderated to a point where they can consider resuming interest rate cuts despite tariff-linked inflation. I still think the core of the Fed at this point wants to wait for more evidence, and the fact that the non-farm payroll report from last month was around 150,000, probably good enough to leave, the wait-and-see stance fully intact. But I think for markets, the question will be, does Powell and the Fed try and lean against the market and basically say, hey, we don't think September is very likely because we're still seeing some signs of tariff inflation? Or are they at least open to that possibility of cutting in September if the conditions allow it? And I think it will be the latter. And so for the Fed, I don't think there's going to be a lot of change in policy, but I think they're going to have to acknowledge that there is certainly a big differentiation among the individuals within the Fed, and that there's some that see a path to cutting as soon as September, and they might leave that door open if the data allow it.
Yeah, we've just had another central bank actually join that kind of wait and see mode in terms of monetary policy, though at a very different stage of the easing cycle. And Paul, just to bring you in here, in the aftermath of that ECB decision, what do you think this means for future ECB outlook and for the market impact?
Yeah, it's interesting listening to Brian there. I was wondering whether Trump would like to trade the Fed to the ECB, because the ECB has got interest rates down significantly below rates that are prevailing in the US. Of course, the outlook here in the UK, in the euro area, is dramatically different to the one that the Fed finds itself. Higher inflation, worries about tariff inflation as well. The ECB was never, well, they kept rates on hold. The market thought that they would keep rates on hold with high conviction, and the ECB didn't disappoint. The guidance over the last few months has definitely been one of no change in policy through the summer. We'll come back after the summer. We'll see what the news on a possible EU-US trade deal looks like, and then we can reassess the outlook for inflation and growth. In terms of the detail, the statement was relatively brief. It was unchanged, no change to the outlook. The ECB's got inflation essentially at target. Inflation expectations are around the 2% target in the future, and their forecasts suggest that inflation in the future will be at target. So there's very little reason for them to be signalling anything. I think at the margin, though, it was a slightly more hawkish outcome than dovishly priced markets had expected, most obviously around September. So you saw the euro, for example, try to rally. Markets were a little bit less confident that the ECB ultimately cuts towards the end of the year. But it's all going to be about these trade announcements, and it does feel like they are moving to some kind of agreement. The level of tariffs obviously feels like it's going to be higher than 10%. 15% is the one that's been in the media. I think there were fears that it was going to be higher. You never know to what extent this was just trying to manage expectations, and then when you get a deal that's slightly better, it's more positive. But ultimately, that will determine whether the ECB has finished cutting rates, and we think that they have. I mean, ultimately, if the outlook deteriorates a little bit, or inflation comes in a little bit weaker than expected, then yeah, for sure they can cut again. But it feels like the ECB is done cutting, and it will be interesting to see how that compares to the Fed going forward, and that's going to be important to FX markets.
Yeah, what do you think is kind of the biggest driver for the euro outlook from here? Is it that monetary policy divergence, or is it kind of trade policy, which is very much in the driver's seat?
Yeah, I think there's a number of drivers of the euro, most obviously euro dollar. It's one of them, I think, is just this structural euro short in the market that's been around for seemingly forever, 5, 10 years, and I think that's got potential to adjust. I think the optics of the ECB having finished cutting rates when maybe the Fed will cut again at some point. I mean, at the moment, the view of our US colleagues tracking extremely well. I mean, they've had quite a lot of pushback. The idea that the Fed doesn't ultimately cut this year. There's a lot of people who thought that they would cut really aggressively. So let's see how that relative monetary policy plays out. But the optics are certainly a little bit better. I think it's really interesting, actually, for euro dollar how it's been quietly trending higher. So you've had this trending high trading channel pretty much for the whole year. We came down to the bottom of it as the dollar started to outperform a little bit. But over the last week, we've drifted higher again. We've had a little bit more of, at times, escalation around trade, a little bit uncertainty about the Fed leadership role, and that certainly hurt. So I think for the euro, it's not the dollar, and it's the US. The outlook for Europe is maybe through the point of peak pessimism. Maybe institutions are better respected in Europe, and maybe the euro is just catching a little bit of a bid for that, and we think it will ultimately continue to do so. So euro dollar at 120 is still our target. Maybe we can go a little bit higher than that at some point, but ultimately I think the relative performance of the two economies probably stops it going significantly higher.
Yeah, and the other big kind of upcoming central bank meeting we have is the Bank of England. What are we expecting there?
Yeah, so we expect a quarter point cut at the August meeting. It's certainly interesting to compare it with both the ECB and the Fed. So the Fed sort of wait and see. The ECB feels like they're done and they're communicating. We still think that the Bank of England will keep to their gradual and cautious easing cycle. So we get a cut at August. We think we get another one in November, and then they're pretty done. I mean, it'll be interesting to see what the Bank of England can do if the ECB is in fact on hold and the Fed is very close to, maybe at terminal as well. With these meetings, it's not necessarily about the decision in itself, because markets fully expect the Bank of England to cut 25 basis points in August. It's clearly not a secret. They've guided to that, and we think that they deliver. So it will be about the formal guidance, and it will be about the vote count. With the formal guidance, we don't think it's time to change that. Certainly with inflation coming in a little bit higher than expected, employment being revised, I don't think they would want to signal to the market that they might speed up cutting rates. They might ultimately, if the labour market weakens more than expected, but as we described in recent podcasts, the upward revisions to the employment outlook, I think will make some of the members on the MPC a little bit more cautious. In terms of the vote count, it could be pretty much anything. I mean, we've gone for 9-0, so all members of the MPC voting for a 25 basis point cut, but you could easily get 8 voting for 25 cut and Peel, the chief economist, again dissenting and not wanting to cut interest rates. You might even get a couple that want to cut the base rate by 50 basis points instead of what we think of 25. See, I mean, I've got to write them down, you could get a 6-2-1. I mean, certainly when those headlines hit the screen, that will be interesting. But I think it is a more cautious outlook for the Bank of England, but we're getting mixed messages. You've got the PMI numbers today had cost push price pressures, but a really weak employment balance and weak output data as well against the higher inflation and more resilient sort of labour market in general. So that was a long way of just saying they're going to cut as everyone expects, and they might do again as everyone expects come November.
But the vote count is a big risk factor, is what we're getting. And I know you're always a perennial sterling bull. Sterling has been quite weak recently. Has it changed your fundamental view, or still bullish sterling?
Yeah, it's been hard yards, isn't it? Hard going for a sterling bull like myself. And as I mentioned last week, and it's been clear that the currency has been weaker than I personally expected. I thought the sort of gradual cutting, cautious Bank of England when the ECB was cutting, and potentially for the Fed to cut, I thought that would help the currency. I mean, sterling dollar has been rising, so sterling has been participating in this weaker dollar environment, but it's been lagging other currencies. So that move in sterling dollar is more of a dollar move rather than sterling, and it's sort of lagging a little bit. I think some of that is the fiscal risk premium. I think just the worries about the welfare bill and what the autumn budget might bring in terms of tax hikes that slow growth, that leads to the Bank of England to cut rates more aggressively, I think have weighed a little bit. I actually think that that's a little bit far or too pessimistic at the moment. I think you'll just get modest adjustments to fiscal policy in the near term. I think over the next 3 to 5 years, then more significant changes to fiscal policy will be needed, and then it'll be interesting to see to what extent they can actually come through. But short term, I think it's a little bit overdone. And I think the Bank of England, once we get through the August meeting, if the Bank of England stay to their cautious stance and they reference the data that have been better than expected, higher inflation, then I think it might just cause a little bit of position squaring. So still staying with it, but maybe with less confidence than I have done for a little while.
Still bullish, a little less conviction. Perfect. That's probably all we have time for. Paul, Brian, thank you so much for joining me. And thanks for watching, everyone. If you did like the podcast, do like and subscribe, and definitely join us again next week.